Bismillah Rahman Rahim. Welcome to Financial Appraisal Part 2. Here is Nidhi Mashraf. In Part 1, we discussed what is appraisal, different types of project appraisal, terminologies used in financial appraisal, and different methods. The first methods was discussed, that is NPV in Part 1. In this part of video, we will discuss the second two parts, that is IRR, internal rate of return, and BCR, internal rate of return. The internal rate of return is basically annual rate of growth that an investment is expected to generate. An IRR of 10% with a discounted rate of 10% means the project is at break-even point. Now, what are the applications of IRR? Basically, IRR is used to estimate the profitability on capital investment or the project which we are going to implement. Second one is IRR is used to compare potential rate of annual return over time of that project. Third one is the IRR helps companies decide whether or not to proceed with that project or that investment, and a company may not follow the IRR method if project has other less tangible benefits. Mean the IRR tells us that we should consider this opportunity of investment or project, but in the other sense there is no tangible benefit, not much benefits, so the company may defer those projects. What are the advantages to use the IRR? Basically, it's very easy to calculate and understand. The calculation formula of the IRR is same as NPV. IRR helps companies and investors to consider time value of money. Time value of money basically is, you can say, the amount of money will be worth more now than the same sum in the future. What are the advantages to use IRR method? First one is disadvantages. First one is IRR exclusively can lead to make poor investment decisions, especially if comparing two projects with different durations. Mean one project has a duration of 1 year, second one is 5 years, then we cannot compare those in the term of IRR. Second one, IRR does not take actual dollar value of the project, mean cash inflows and outflows. Third one is IRR doesn't consider anomalies, irregularities, in cash inflows and outflows. And fourth one is IRR can be misinterpreted if used outside of appropriate scenarios. Next one is BCR, benefit cost ratio method to calculate the financial appraisal. What is BCR? Basically, it is a tool, a systematic approach to evaluate and compare the cost and benefit of different project proposals. BCR is an indicator showing the relationship between the relative costs and benefits of a project, of proposed project, expressed in monetary or qualitative terms. The formula which is used to calculate the BCR is equal present value of benefits expected from the project by present value of cost of the project on investment. To calculate BCR, we need present value of benefit is divided by present value of cost. Mean, to get the BCR, we only need the present value of all those benefits which we are expected to get from that investment or project, and the second one, the present value of all the costs which are incurred in that project. If a project has BCR, benefit cost ratio, greater than 1, the project is expected to deliver a positive net present value to a firm and its investor. Mean, it is a good sign. We should consider that investment opportunity. We should do that project. Now, what are the different applications of BCR method? It is used to determine the viability of cash flows generated from a project. BCR is used to describe the connection between cost and benefit of a potential project or investment. Which project to choose from multiple available options? BCR will tell us which option should be availed. And the last one, to ensure that you are using your scarce sources in the best possible way. Now, the BCR values may be less than 1, equal to 1, or greater than 1. In case of calculation, the BCR value comes less than 1. It means the net present value of project of our investment is negative. It's below the discount rate. The project is destroying, and we should not consider, because the costs of the projects overweigh the benefits. So we should reject we should not consider that investment opportunity. But in case of BCR is equal to 1, mean net present value of that investment opportunity of that project is 0. The IRR of project is same as discount rate, mean there is no profit, no loss. The project will neither create nor destroy the value. So, if there are other tangible benefits to the firm, mean its brand name, loyalty to the customers, that project may be considered, otherwise not. But if the value of BCR is greater than 1, mean its net present of value of that opportunity investment or that project exceeds 0, mean internal rate of return of project is greater than discounted rate. The definitely project will generate incremental values. The project will give us profit, so that project should be considered. We should avail that project opportunity. There are different advantages of BCR. It gives project feasibility. It is easy to calculate, but there are some limitations of BCR also. BCR depends heavily on assumptions, mean marketing conditions, dollar rates, and some others. It does not consider the project size. If there are two projects with a different project size, it will not give which project should be considered. And it's very sensitive to forecasts and discount rate. And the last one is the other benefits, such as non-monetary benefits, employees morale, customer satisfaction, and brand reputation is not considered in this BCR calculations. Finally, we can say all these three methods, financial methods, NPV, IRR, BCR, are simple tools to calculate the feasibility, viability, and attractiveness of the project and investment. Every tool has its benefits and disadvantages, so they should not be used solely. At the end, it is recommended that financial assessment tools must be used in conjunction with other types of analysis to make a good decision on capital investment. Thank you so much.